Okay, so this video is probably going to be a lot longer than the videos that I usually make, because in this video I'm going to cover how to trade options for beginner. I'm really going to try to cover from A to Z everything you need to know, like what are options, what is, for example, buying options, how you can benefit from them, what makes an option price. Basically, we're gonna cover a lot of ground in this video. But first and foremost, if you're a beginner, you just heard about options and you're willing to learn more about them, don't hesitate to put like any question that you would have in the comment section while watching the video. It would be an absolute pleasure to help you maybe understand a bit more about options. And if you don't understand everything, at first watch, know that it's completely normal. It's a very complicated subject, and personally it took me a really long time to really grasp everything when it comes to options, so don't worry if you don't understand everything. Options, as I said, is a pretty complex subject to master, and it just takes a lot of time. And at first you're probably going to understand some points here and there. One day you learn one thing, one other day you learn some other thing, and then after a while you start making connections between all the things that you learn and you start getting better options. So don't worry if you don't understand everything at once, don't get discouraged, it will take time. The goal of this video is really to try to make an all-in-one video, and it's a pretty hard thing to do, to be honest. Like, it took me a long time to prepare this video, so hopefully it will work out and the message will come across. But before we talk about options on stocks in particular, I think it's important to understand the concept of options, because there are actually quite a lot of real-world applications to options in general. We just focus on stocks, but let's rewind a bit and let's understand what are options at first. And for that, let's use an example where, let's say you're willing to buy a house. Let's say that you have some cash on the side and now you're really willing to buy a house that you think that's going to be a nice investment. Let's imagine that you spot a very nice house, let's say in the south of France, because I'm going to take the south of France as an example. If you hadn't heard already, I'm French, so I'm going to use France as an example. What, you have no choice, I'm sorry about this. So you found a nice house, and let's say that the cost of this house is $500,000. Okay, so that's the price of the house. However, there's a tiny problem here. You learn that there actually might be a highway that is going to be built next to the house in a year or so. So now you're wondering if it's actually worth buying the house. Is it actually better to buy the house, pay $500,000 and take the risk that there might be a highway that is going to be built literally next to the house, and so the house will lose value, or not buy the house and potentially missing the opportunity to buy this house because the highway might not be built in the end? That's not a certainty that the highway is going to be built. So you have a pretty tough choice in front of you. You don't really know if the highway is going to be built, but at the same time, you don't want to spend $500,000 if there is going to be a highway literally next to it. That will make the house lose value, and it's really not ideal for you. So what should you do? Should you go for it, or should you maybe search for another house and maybe miss out on this house that you really like? Well, you could buy an option on this house, and here's what this option could do for you. Let's say that you buy an option on the house. So let's say that the option is going to be worth, I don't know, let's say 50 grand. You buy an option on the house that is going to give you the right to own the house before, for example, 2 years in time. So if you decide to buy the house, let's say in 1 year, then in that case, you can exercise your option, and so you'll have to pay $500,000 for the house. But if you decide to not exercise your option, that option that you're going to buy for $50,000 is going to give you the right to own the house. And by doing so, you make sure that you still have the possibility of owning the house, so no one else can actually buy the house because you have an option on it. And here's the real benefit of buying, for example, that option at $50,000 for this house. If the highway project is actually being dropped, no highway is going to be built anymore, then in that case, you can actually exercise your option that you have bought for $50,000 because you're sure now that the highway is not going to be built. So now you can actually pay $500,000 for the house safely without the fear of potentially having a highway being built next to it. Or if the highway is indeed being built in a year, then in that case, you just don't exercise your option and you will only have lost $50,000. So that's basically the two outcomes possible. Either the highway is being built, and in that case, you just lost $50,000 because you're not going to exercise your option if there's a highway that is being built next to it. Or the highway is not being built, and in that case you can decide to exercise your option on this house, and so now you can safely pay $500,000 without any highway being built next to you. Why am I talking about a house and a highway in the south of France? Well, hopefully you understood why I talked about option on this house and why it can actually be quite a smart move to buy this option on this house, because at least you don't risk $500,000, you only risk $50,000, and if the highway is indeed being built, then in that case you only lost the price of the option that you paid for, not the whole investment, not the whole $500,000. Well, I think that's a pretty good example, because that's exactly what options are at first. Options, they exist for a ton of things, like houses, as I said, apartments, businesses. You can basically buy options for a lot of things, like train tickets, for example. And that's exactly what options are at first. And of course, we're going to talk about options on stocks and what do they mean, what are calls and puts and everything. Don't worry about this. But it's so important to understand what initially options are, because it helps you go step by step and you make sure that you have the right fundamentals. So options are just contracts that give you the right to own something. Either it's, for example, owning a house, like in the example that I said, or you can buy an option for like a train ticket. If you're not sure to leave somewhere, you can buy an option that is going to be a small price. And if you decide to pay for your train ticket or for your plane ticket later, then now you can have the right to buy the plane ticket at an agreed price. That's what options are in the real world. So now that we understand this, we can go with a bit more understanding when it comes to options on stocks. When we talk about stocks, options are contracts that give you the right to buy or sell shares of a stock. And there are two kinds of options: calls and puts. When you buy a call option, that gives you the right to own 100 shares of the stock. And when you buy a put, you now have an option that gives you the right to sell, or short as we say usually, to sell 100 shares of a stock. Because you know that when you're, for example, trading stocks, you can buy the stock and so you're going to be bullish, you bet that the price is going to increase, or you can short the stock and so you bet that the price is going to decrease. And that's exactly what those calls and puts represent. When you buy a call, then you are going to be bullish because that gives you the right to own 100 shares. And then when you buy a put, then you're bearish because that gives you the right to short 100 shares of the stock. But you probably ask me, okay, but why would I want to buy an option on the stock? Why does it make sense? Let's say that you're interested, for example, in a stock that has been going up recently. It has been going up, and in your opinion, it's probably going to go even higher. You think that the stock is going to go to the moon, as we say. Well, instead of, for example, buying the shares directly, let's say that you want to buy 100 shares, and for the sake of the example, let's say that right now, the stock is around $100 per share. So if you decide to buy 100 shares of a stock that is at $100 per share, then that's an investment of $10,000. But for you, let's say that $10,000 on a single stock is a bit much. So you decide to buy an option on it. For example, you decide to buy a call option because you're bullish. Well, let's say that the price of that call option is, I don't know, let's say worth $1,000. It's only like 10% of the total cost of the total $10,000. Well, that option, basically that call option, gives you the right to own 100 shares of the stock at an agreed price before a certain date. It means that if, for example, the stock goes up, indeed, and you were right, the stock is indeed going up, then in that case, you can decide to exercise your call option, own 100 shares of the stock, and so you indeed make your money. That's great for you. But on the other hand, if, for example, the stock starts declining and you were wrong about your assumption and actually, the company fails or something happens and the stock declines, well, in that case, it's not that bad because you will only have lost your premium of $1,000 compared to if you had bought the shares, then, you would be invested with $10,000 on the table because you would have bought 100 shares of that stock. So the most you could lose because you only bought that option is $1,000 compared to, on the other hand, the most you could lose is $10,000. So you see that it actually can make sense to buy an option if you still want to have the right to own the shares, but you don't want to risk as much as someone who would buy the shares directly. And that's a very basic example, but that basically explains what are options when it comes to stocks. And you probably heard when I described what a call option was, that it gives you the right to own a stock at an agreed price before a certain date. But what does it mean? Well, any option, when it comes, for example, to the stock market, has those different components. The type of option, meaning is it a call or a put? Then you're going to have what we call the strike, which is the agreed price at which you're gonna own the shares if you decide to exercise your option. So I know it's a long sentence, basically to say something very simple. For example, if you buy a call option in our example of that stock, and you buy that call option at the 100 strike, then in that case, if you decide to exercise your option, you're going to have to pay $100 times 100 shares, because one contract controls 100 shares of a stock, equals $10,000. So you see that we have again that investment of $10,000 is because one option always controls 100 shares of the underlying stock. And if you decide to buy a call option at $100 strike, then in that case, you'll need to purchase 100 shares at $100 per share. So an investment of $10,000. So that's for the strike. That's the price at which you will buy the shares at if you decide to exercise your option. Then we have the expiration. Every option has an expiration. So basically you have the right to own, for example, the shares if you buy a call option before the expiration. After that, your option will be expired. And that's the expiration. For example, let's say that you decide to buy, I don't know, the Apple Care. When you buy an iPhone, you are being suggested if you want to buy this insurance, which is called the Apple Care. And you will notice that that insurance has an expiration date, which is usually 1 year, meaning that you have 1 year to basically claim your insurance, to claim your option. So meaning that you have 1 year to basically exercise your insurance. Otherwise, your insurance is going to be expired. That's exactly the same concept. And there is one last element, what makes an option contract. So as we said, there is the type of option called a put, there's the strike, there's the expiration, and there is what we call the premium, which is basically a fancy word to say how much is the option worth, what is the option price. But we call that premium because, you know, why not? It makes it fancy. And to make things a bit more complicated, I know like it already starts being complicated, but as I told you, one option contract always controls 100 shares. So if you, for example, said that an option is worth $1, in reality, that's the price per share. As one option contract controls 100 shares, then the real premium of that option is $1 times 100 because there are 100 shares, so it's $100. So if we say that, for example, an option is worth $1.20, in reality, it means that we're talking about the price per share. So $1.20 times 100, because one option controls 100 shares, and it's equal to $124. And that's usually how you will see option prices being. If you, for example, go into your broker, I'm sure that you won't see, like, for example, $124 as the premium. You will often see $1.24. That will always be written in the price per share. But in your mind, just know that you have to multiply that number by 100 to have the actual option price that you need to pay for if you decide to buy that option. And you'll probably ask me now, but why don't they put like $124 directly? Why do they put $1.24? Just don't ask too many questions, like, you know, just get on with it. So now we understand what options are used for. Like, for example, if you think that a stock is going to go up, you can buy a call option on it. And then if the stock goes up, you can actually exercise your option, buy the 100 shares of the stock, and then, you know, you're going to be making a profit. Everything's great. Or for example, if you think the stock is going to go down, then in that case, you can go buy a put. And in that case, you have the right to short 100 shares of the stock. So if the stock goes down, you can now exercise your put, and now you can short 100 shares of that stock at the agreed price, at the strike price. But you're probably wondering, okay, I get what is the use of an option, but what is actually options trading? Well, let's see together what is options trading. So I told you that when you buy an option, you have to pay a premium, of course, you know, every option is going to have a price. And that premium, I even told you that usually it's being referred, for example, as like $1.24. And in reality, that means that the option is worth $124 because there are 100 shares in that contract. One contract always controls 100 shares of the stock, but usually we write it as $1.24. We all on the same page now? The thing is, when you're going to go, for example, buy options on stocks, let's say that you buy an option, I don't know, for example, let's imagine that this chart is the Tesla stock. So basically, I could just go straight up like this. This is Tesla. Let's imagine that you bought an option, for example, when the stock was right there. Here, you bought like a call option, okay? So you were essentially betting that the stock was going to go up. And to make it simple, let's say that you bought that option at $1.24. So that was your price. That was the premium that you paid when you bought that call option. The thing is, I a bit lied to you just before when I said that you could, for example, exercise your shares. It's not that it's not true. It's just that actually almost no one does it. And here's the reason why. If you, for example, see that the stock is going to go up, what is going to happen to that premium, to the premium of the option that you bought, is that the premium is actually going to increase in value. Now, instead of, for example, being worth $1.24, the premium of the option that you bought before is now going to be worth, for example, let's say $4. And now it means that you're basically making a profit on the price of the option. You bought that option for $1.24, so $124, and now it's worth $4 or $400, as once again, there's 100 shares in every single option contract. So now it's worth $400. You're basically making a profit of $2.76 or $276 on just that option, that you bought. And then once the stock went up, the option premium got more expensive, and so now you're able to sell it again and making a profit of $276. And that's why I was jokingly saying that I lied to you, because the truth is not many people are going to actually exercise their option as the intended purpose. We're going to, for example, buy or sell options, so we're going to make a profit as the premium, as the price of the option is fluctuating, exactly like in this example with the Tesla stock. And that's what option trading is. And that's what options trading is. And now you're probably wondering, okay, cool. I get that you, for example, buying an option and then you're selling it at a higher price and making a profit. But if you're just doing this, why don't you just trade the stock directly? Because it would probably be simpler to just buy the stock and then sell it at a higher price. You know, like, why complicating ourselves? Well, there are a couple of reasons why people buy options. They're going to buy options because it only requires a fraction of the cost. Compared to if you were, for example, buying 100 shares of, for example, Tesla, well, by buying a call option on Tesla, you're going to pay much less, and still you're going to be able to control 100 shares of the stock. So that's why a lot of people are going for it. Options is a leverage product, which can be good and also bad. As we always say about leverage, it can magnify your gains and deepen your losses. So you need to be careful about leverage. But this is really one big reason why people are trading options, is that they have access to leverage. And another reason for me, which is a lot more appealing rather than the leverage itself, is that you have a lot more flexibility and customization in the trades that you make. You can benefit from stuff that you won't benefit from when you're just trading the stock. And I'm not going to go into too much details right now because that's not like the moment to talk about it. That's maybe a bit too complicated. But I'm going to talk about it after in this video. But for the moment, just remember that the two main reasons why people are going for options is because of the leverage, so you can have more gains, but don't forget that you can also have bigger losses, and also the flexibility that options are offering. So now that we saw a bit of theory, a bit of the fundamentals to know, and by the way, I hope that it's going well. I hope that you're surviving. So don't hesitate to let me know if you're enjoying this video, because I'm really trying to make it as simple as possible, and I'm trying to make it as understandable as possible. So let me know in the comment section if you're actually enjoying this video. But now I want to bring some more practical approach to this video. So let's pretend we were actually going to buy a call option together. So the first thing that we need to choose is the stocks. So let's say that I'm going, for example, for Bank of America. And by the way, I'm using the TestYourWorks platform right now. So if you don't know, TestYourWorks is a broker that I personally use myself. And if you're new to options, I would strongly suggest to use that broker. And you don't have to use my referral link. Just, if you want to go on their website, use that broker. For me, they're kind of the best. There's also Thinkorswim that is great if you want to use another broker. Those are the two main ones that usually people are going for, either Thinkorswim or TestYourWorks. Some people are also going for E-Trade all of those are great brokers. They're all pretty much going to look the same. There may be some differences between the different brokers, and in this video I'm going to use Tastyworks. So let's say that I'm willing to buy a call option on Bank of America. How would I do this? So I'm going to type the ticker symbol, so it's BAC for Bank of America, and now the first thing that we can see is that we have a lot of different dates in front of us. You see that you have November 19, November 26, and you have like the number of days that there is until that date in the middle column. Basically, you have a lot of dates, but what does that mean? Well, those are the different expirations that you can choose for your option. Remember that I said that in every option there is an expiration date. Well, that's what it is. You first need to know when is the expiration that you want to buy the option for. And once again, I'm not going to go in too many details about which expiration. That's something that we can talk later once you have a bit more knowledge. For the moment, let's just say that I'm going to choose, let's say, the November 19th expiration. When I click on the November 19th expiration, you see that I have a lot of things that appeared on the screen. In the left part, at the blue line, you can see that it's written calls. And on the other hand, you see that it's written puts. So on the left side, you're going to have all of the different call options. And on the right side, you're going to have all the different put options. You can see in the middle that there is those numbers like 43, 43.5, 44, etc., etc. Those are what we call the strikes. So this is the agreed price at which you're going to own the shares at if you decide to exercise your option, or for example, short the shares if you decided to buy your put. So now you probably are wondering, okay, so that looks like a lot of strikes that you can choose from. Like, which one should I go for? And once again, I'm going to tell you the exact same thing that I told for the expiration. We will see that later. We will see the differences between the strikes and which ones I usually go for. But for the moment, it's really not important. I just want to show you an example as if you were buying a call option. So for the sake of the example, let's say that I buy, for example, the 47 call option. You see that now I have this one in green, which means that I selected the 47 call option, meaning that if I decide to buy that option, then I'm going to have to pay 65 cents per share, or $65, as one option controls 100 shares of the stock. So now I hope you understand why I was telling you about this, you know, like 0.65 cents and now $65 because there are 100 shares, and I know that's just how it's written. Just don't ask me why. Get on with it. So if I go on and I actually buy that option, well, now I'm going to pay $65, and I will now be the proud owner of that 47 call option. And if at some point I decide to exercise my call option, then I will be able to buy 100 shares at $47 per share, regardless of where the current stock price is. But as I said before, now you know it. If, for example, Bank of America is going at $80 per share, I'm just going to resell my option because it will have increased so much in value that I'll just be making a ton of money. I don't need to go through exercising my option. I mean, you can just resell your option and boom, you made a profit. That's why people are just trading options. They don't go through the exercising process. They just resell the option that they bought before, and they just make a profit that way. Okay, so we have covered a lot of ground already, and I know it's a ton of information. So I just wanted to make a break here and review a bit what we've been seeing before, because I know it's a ton of information, and if it's the first time that you watch a video about options, then I know it's a lot. So as I said before, an option is a contract that gives you the right to own or sell 100 shares of a stock at an agreed price, which is the strike price, before a certain date, which is before the expiration. Calls gives you the right to own 100 shares, and so you're bullish when you buy a call. And puts gives you the right to short 100 shares, so you're bearish when you buy a put. People usually trade options for two main reasons that I see. The first one is that there's leverage in options. As I said before, when you buy an option, you buy the option for a fraction of the cost compared to if you had bought 100 shares of the stock. Because you pay a fraction of the cost and still controls 100 shares of the stock, then, you know, that's called leverage, and people love that. And that obviously can magnify your gains, but as we always say, it can also deepen your losses. So you need to make sure that you know what you're doing. That's why you're watching this video. Thank you very much, by the way. And the second reason why people usually trade options is that compared to trading stocks where you can just buying shares or selling shares, With options, you have a lot more flexibility. As you just saw before, now you must have some feeling that it can be a lot more complex. You need to choose the expiration, and as you saw for Bank of America, there can be a lot of expirations, and there are on top of that a lot of different strikes available for all the different expirations. So you can see that there is actually a ton of choice that you could make for just one trade. And as much as it can seem overwhelming at first, which I completely get, by the way, on the long term, it's actually the best thing because it allows you to have a lot more flexibility. And as I said before, you don't need to know this right now. I'll come back to it later. So I'm going to make a break here because right now I still need to do other stuff in my day. You know, I don't only have YouTube. So I'm going to go do other stuff and I'll come back tomorrow to continue this guide. Welcome back to another day in paradise. Now that we've set up some nice foundational basis in the first part of this video, now we're going to go into a bit more details about what makes basically the option price change, how you can take advantage of this. We're going to talk also about strategies, what is selling options, and basically we're going to also cover a lot of stuff. So once again, as for the first part of this video, I really advise you to, you know, just take a pen, maybe take some notes, rewatch some parts of that video that you haven't maybe understood, or, you know, ask some questions in the comment section. Really just, you know, do your thing. So far you understand, for example, what is a call option, what is a put option, what does it do when you buy an option, what is your right to exercise and so get the 100 shares. So far we're all good on this, but you're probably wondering, is only the option price depending on the stock price? Meaning that is only the stock responsible for the option price movements? Is it only going to be responsible for that? And I know of course that no one is wondering this type of question. I just need to have a nice transition, so let's get over it. The thing is, there's not only the stock price that is going to influence the option price. There's not only the stock moving that is going to make the option price either getting more expensive or cheaper. There are other factors that come into the game. So let's break down what an option price is actually made of and what makes it change. There are mainly two components in an option premium. There is what we call the intrinsic value that I'm sure you probably heard of, and there is the extrinsic value. So for the sake of simplicity, I'm just going to refer to the intrinsic value by IV, and for the extrinsic value, EV. So basically what makes an option price, you're going to have intrinsic value and you're going to have extrinsic value. But what are those two? So first of all, what is the intrinsic value? So the intrinsic value is the value that an option would have if it was being exercised today. And to make you fully understand what is the intrinsic value and the extrinsic value, we're going to look at a current call option that I'm looking at on the SPY, and we're going to break it down between the intrinsic value and the extrinsic value so you can see what it means. And I'm going to explain it all along. So don't worry, we're going to do it together. Let's say that you're looking at a call option on the SPY. The SPY is the ETF for the S&P 500, and you're willing to buy a call option on the SPY. You're looking, for example, at a call option, so a call that has a strike of, let's say, 465. Ooh, that was a terrible 4. Let me do it again. The premium, meaning the option price that you're going to have to pay to own that call option, is of $5.87. So $587, but now you know that we refer to premium as $5.87 because it's the price per share, but as one contract controls 100 shares, you need to multiply that number by 100 to know the total premium that you're going to have to pay. And the current price for the SPY is of $470.34. So let me just write it right there. Okay, so now we have basically quite a lot of data. We have the call option strike, meaning that it's the 465 strike. We have the premium, meaning that the option costs $5.87, so $587. Then we have the current price for the SPY, which is of $470.34. So now, if we focus on the option price, meaning the option premium, I told you that basically within that premium, you have extrinsic value, but you also have intrinsic value. But first of all, let's focus on the intrinsic value. So the intrinsic value refers to the value that an option would have if you were exercising it right now. If we imagine that you're buying, for example, that option, so you pay $587 to buy that call option at the 465 strike, and you decide to exercise your option directly, what is it going to do? Well, you're going to own shares at $465 per share, times 100 because there are 100 shares, and then in the end, you're going to have to pay $46,500 so as to buy 100 shares of the SPY, as the price per share is $465. So that is your investment. But as the current price for the SPY is of $470.34, if you decide to sell your shares right away, you're basically going to sell your shares at $470.34. And because you had bought 100 shares, you're going to directly make a sell of $47,034. So in the end, the profit that you're making, and in the end, by selling your shares at $470.34, you're going to, in the end, make a profit of $47,034 minus $46,500, your price, your total investment when you decided to exercise your call option. And in the end, you're going to make a profit of $534. So is that easy? Is that easy that you just exercise your shares and then you make a profit by reselling your shares? Of course not. And here's the reason why. Don't forget that you bought your option at $5.87. And of course, the market is going to adjust the value of the option, because you're not going to be able to just buy a call option, then exercise it, then just resell the shares and make a profit and just do it again, job done. That just doesn't work that way. If you decide to buy a call option and the current stock price is already above your strike price, then we say that your call option is in the money. And when options get in the money, they're going to gain intrinsic value. So, and as your call option has a strike of $465 and the current stock price is of $470.34, then in that case, your call option is in the money by $5.34. And that's the intrinsic value. And that's the intrinsic value that your option has. So the premium is going to be a combination of $5.34, which is the intrinsic value because your option is in the money. And then you're going to also have extrinsic value, but we're going to talk about this later. I just want to focus on the intrinsic value so we make sure that you understand this. The intrinsic value is the value that your option would have if you were exercising your option right now, meaning that in our case, it's $534. So the intrinsic value for our option that is costing $5.87, we know that it has an intrinsic value of $5.34. That's the intrinsic value for your option. And if it still doesn't make sense what the intrinsic value is, just think about it that way. If you were exercising the option that you're buying right now and you were reselling the shares directly at the current stock price, what would be the outcome of this? Would you actually make a profit on that? If yes, then that is what the intrinsic value is, because of course you're not going to make a profit overall because you will have paid that intrinsic value in your premium that you paid. In our case, we paid $5.87. So if I just bought the shares at $46,500 and then reselling them at $47,034, then yes, I would make a profit of $534 on the paper, except that because I paid the option premium at $587, then I'm actually making a loss overall. And of course, the markets are not stupid, they're going to adjust themselves according to how far in the money, that's how we call it, in the money your option is. And that you're going to have to pay it. That's the intrinsic value. So now that we know what the intrinsic value is, meaning it's $5.34 out of those $5.87 that we paid for the option, well, now let's talk about the extrinsic value. The extrinsic value is really, in my opinion, why options are just so amazing. And honestly, the extrinsic value is probably the most fascinating thing that you will probably understand about options. And let me explain you why. You see, when we talk about options, for example, in general, even when we talk about options on houses, like in the example that I mentioned at the beginning, or we, for example, talk about the Apple Care, which is, for example, an option. When you think about it, like all of those things, the value that you're paying is not just based on, for example, the product. There's also other factors that come into play. And that is often referred to what we call the time value. And let me give you an analogy before explaining it, because it's always better with examples. So let me ask you a question. So I'm sure that a lot of you that are watching this video, you probably have a car. And so you probably also have a car insurance. Let's say that I'm offering you a car insurance that is basically going to cost, I don't know, let's say $1,500 per year. Okay, so that's the price of the car insurance. Let's say that you buy this car insurance, so you pay $1,500. So the moment you buy it, your insurance is actually worth $1,500, right? But now let's fast forward in time. Let's fast forward to, let's say, I don't know, a week before your insurance actually expires, before your insurance doesn't cover you anymore. Is that insurance still worth $1,500? Would you still pay for that insurance that is only covering you for a week now? Would you still pay $1,500 for it? Of course not. And the reason is that it's very unlikely that something is going to happen to your car between now and the end of the week, or at least it's not worth $1,500 because that's the price of an insurance that would cover you for a year. So it's not really worth paying $1,500 for a car insurance that is only going to last for a week. So what's the point of this? Well, the point of this is that there is value in time. The more an option has time between now and the expiration, the more value there is in the option because there is more likeliness that something is going to happen in between. Compared to a car insurance that is only going to cover you for a week, you're not going to pay the same thing, obviously. You're obviously going to pay more for an insurance that is going to cover you for a longer time because now you're protected for a longer time period, and it's more likely that something is going to happen on a longer time period compared to a very short time frame. And that's exactly the concept that applies to options when we come to stocks. Now we come back to options, I know, but I need to explain the big theory game before going into the granular details. I'm sorry about this. And the further away the expiration of an option is, the more value there is going to be in the option. And the shorter the expiration of an option, the less value there will be because there is less time in between now and the expiration. So less likely that the option is indeed going to end up, what we say, in the money, as I just said before. And so that implies that as time goes, all insurances are losing value. And what's cool when it comes to options, when we talk about options on stocks, is that you can really quantify that. You can actually say how much value an option is actually losing on a daily basis. And you'll see that for the later part of this video, when we're going to talk about Greeks and stuff like this, is going to actually be really useful. So within the extrinsic value, you're going to have, first of all, how much time is there between now and expiration. But there is a second factor that we need to look at. And for this, once again, let me ask you a question. I'm sure that a lot of you probably live in, zones where there's probably hurricanes happening or something like this. If you try to buy a hurricane insurance when there is almost no chance that a hurricane is going to happen, it's probably going to be extremely cheap because there is almost no chance that a hurricane is going to happen. However, if you know that there is a hurricane that is going to come and that your house is literally straight in the way of that hurricane, then the insurance is probably going to be a lot more expensive for you because there is a lot more likeliness that the hurricane is going to hurt your house, and so the insurance is going to have to pay. So obviously the insurances are going to be more expensive for the people that are basically at risk. That's how it works. Exactly like anything else. That's how, for example, credit scores work. If you're, for example, more at risk to default your loans, then you're going to have to pay more interest because there is more likeliness that you're going to default on your loan. And the same concept, once again, the same concept exactly applies to options on stock. The more likely it is that there's going to be a big movement on the stock, the more expensive the options are going to be because there's more likeliness that the options are going to end up in the money. And one very good example of this is if we look back at the situation with GameStop. I mean, when GameStop was happening, like even if the stock was like a $60 stock, the options were priced so expensive as if the stock was super expensive because there was so much hype. We were expecting so much of GameStop that the options were priced accordingly. And that has actually a name. That's called the implied volatility. And that's the second factor that comes in when we talk about the extrinsic value. That's the implied volatility. And that's extremely important, honestly. Like, that's probably one of the most important concepts when it comes to talking about options. So those two factors together are actually making the intrinsic value. And in the end, when you regroup all of this, when you put like how much time is there until expiration, what is the implied volatility for the stock, and then is there intrinsic value, all of this make the option price. So I know that it was an extremely long, complicated and discussion just to arrive to the point that we talk about what makes an option premium, but that's just how it is. Let me know, by the way, if you have any comments, if you have any question in the comment section. One thing to mention is that only options that are already in the money have intrinsic value. And of course, because as we saw before with our example of our SPY option that was already in the money by $5.34, only options that are in the money have in the end intrinsic value, because intrinsic value only refers to the value that an option would have if it was being exercised today. So if an option is what we call out the money, then in the end it doesn't have intrinsic value, it only has extrinsic value. Actually, all options have extrinsic value, but not all options have intrinsic value. Out the money options only have extrinsic value, while in the money options have extrinsic value and intrinsic value. If we take back our example of the SPY options, you remember that the premium was costing $5.87, and within those $5.87 there was $5.34 of intrinsic value. And actually we can know very easily how much extrinsic value it is if we just subtract the $5.34 to the $5.87. And of course, without any calculator, that makes an extrinsic value of 53 cents. And within those $5.87 of premium that you would have paid for at the beginning for that call option, you would have $5.34 of intrinsic value and 53 cents of extrinsic value. So now you basically did the hardest. Like, if you managed to understand all of what we just talked about, like, trust me, you already did the hardest. Now it's only going to get easier and easier from there. Now I want to talk to you about something that is extremely important that I personally love doing and that I felt was very important to include in this full tutorial. It's about selling options. So as we said, when you're buying an option, you have a buyer, meaning that, for example, you're going to buy a call option. And let's take back our previous example where you're going to pay, I think it was $5.87. Okay. Well, when you pay that premium, who do you think it's actually going to? Well, that premium that you're buying is actually going to someone that is going to be selling you that option. And that premium is directly going to get transferred to that, what we call option seller. That's an option seller. So he's going to get your premium that you're buying for $5.87. So the buyer is obviously going to pay that to the seller. And what's cool when it comes to options on stocks is that you can act as an insurance company. You can act as the insurance seller. Compared to, for example, when you buy an insurance on a house, on a car, you cannot act as the insurance company. Here, when you sell options, you actually can, which is pretty cool. Instead of buying the option, it's absolutely possible to sell the option. But what does it do to sell an option? Well, when you sell an option, as I said, you're going to receive the premium. So if you sell an option that has a premium of $5.87, then you're going to receive that premium within your account directly the moment you press that button. And now you're probably asking, okay, but if I receive the money like directly in my account, does it mean that I can directly withdraw it maybe? Well, in theory, you absolutely can. You absolutely can sell an option and you receive instantly the premium because that's how it works. And then theoretically, you can literally like just withdraw the money instantly and just, go buy beers with it. Literally, it's possible. However, there is a small trick there. And of course, there is a trick. As an option buyer has the right to exercise an option. If he decides to exercise that option, then as an option seller, you don't really have a choice except doing what the option buyer wants. So as an option seller, instead of having the right that the option buyer has, you have an obligation. So if an option buyer decides to, for example, exercise his call option, then you have to sell him 100 shares. As an option buyer, when he exercises his call option, he's buying 100 shares. And on the opposite, if instead we're talking about a put option, then in that case, if the buyer decides to exercise his put option, he's going to then short 100 shares of the stock. And you, as the option seller, you're going to have to buy 100 shares of him. So that can be tricky because as an option seller, if you get into what we call an assignment, which is the opposite of someone exercising the option, when you're buying an option, we talk about exercising an option. And then when you're selling options, we're talking about assignments. You're being assigned, and then you have to either buy or sell 100 shares, depending on the type of option that you are being assigned. But why am I talking about this? Why is it actually cool to just like sell options? I mean, it seems like you have obligations if you're being assigned. I mean, it doesn't seem nice actually. Well, selling options is personally my favorite way of trading options, and here's the reason why. If you remember what I just said before? I said that there was this extrinsic value that was happening, and depending on how long there was between now and the expiration of the option, then there was more or less value. And as time goes, then the option is inherently losing value because time is passing. Obviously, you cannot stop time from passing. Or if you know, just let me know in the comment section. Because of that, when you're buying option, you have the time working against you, because literally if we're putting the value of an option in a graph, as time passes, so that would be the time and that would be the value of the option, then you would see basically the value of the option falling and falling and falling over time until expiration. So when you're buying options, you're a bit racing against the time, because if you just let your option be and then nothing happens and you were wrong about the stock, then your option is just losing value over time, which is normal. But you as an option buyer, it makes your P&L go in the red. You're actually losing money. But what's cool is that as an option seller, now you're taking the opposite side of the bet. So now time is actually working in your favor. Time is now becoming your friend, because when you're selling options, if you, for example, selling an option that is worth $1 and you buy it back to, let's say, I don't know, 50 cents, then you made a profit of 50 cents on that option because you're shorting options. So you want the price of the option to go down, compared to an option buyer where he wants the option price to go up so he can sell them at a higher price and make profit. You're going to sell them at a price and then hopefully buy them back at a cheaper price so as to make the difference in profit. That's just shorting. Exactly like if you were shorting a stock. If you're shorting a stock, you want the price to go down and then you can buy it back at a lower price and make the difference in profit. I'm sure you're familiar with this. Well, it's exactly the same when it comes to selling options. You want to sell the option at a certain price and then buy it back, hopefully at a cheaper price, so you can make the difference in profit. So if the time is actually making the option lose value, then all good for you as an option seller, because now time is actually working in your favor. As time goes, and let's say that the option is losing, I don't know, $2 a day, then as an option seller, that's $2 of profit a day in your pocket with just the time passing, which is pretty cool, because now you're not working against time, you're working with the time, which is pretty cool. And there are other advantages about selling options, for example, in terms of implied volatility. Remember that I talked before that within that extrinsic value, there is what we call the implied volatility, meaning that depending on how likely it is that an option is going to end up in the money, depending on the stock's movement, the stock volatility, then the value of that option is going to be either more expensive or cheaper. Like the example of the hurricane insurance that we talked about before. If you know for a fact that there's a hurricane coming, then the insurance is going to be a lot more expensive compared to if we're sure that nothing is going to happen, then the insurance for that hurricane is going to be very cheap because we know for a fact that nothing is going to happen. And what we tend to see usually on the markets is that movements tend to be a bit too overpriced, meaning that we tend to expect too much compared to what actually happens. And if we're, for example, putting this on a graph, let's say that you were basically expecting a movement that is, I don't know, let's say around 10%. Well, actually what we see in real life is that there's only usually movement of around, let's say, 8%. And that 10% is basically what the option price is valued at. And the 8% is what actually happens, meaning that options tend to be a bit more too expensive compared to what they're actually worth on average. And I'll put some link in the description of some, studies that has been showing that options tend to be a bit too expensive compared to what they're worth. And this is for plenty of reasons. For example, the 1987 crash. Since then, put options have been too expensive compared to what they're worth because people use them as a hedge. And I won't go into too much details here because it's not necessary, but just to let you know that usually options tend to be a bit too expensive compared to what they're actually worth. That's why as an option seller, it's also quite nice because you're collecting more credit, more premium when you sell options, and so you're making more money in the end. But is all of this actually quantifiable? Is it possible, for example, to see how much value an option is actually losing on a daily basis? Is it possible to see, for example, how much value an option would gain or lose depending how the stock is moving? Is it possible to see that? And that's what we call in the option trading world the Greeks. And to give you an analogy, like let's imagine that you were, for example, like driving a car. Well, the Greeks would be, for example, what the speed, the indicator, like the speed indicator, like for example, the level of fuel that you have, like basically all of this that you can see in your car that basically basically tells you information would be what the Greeks are for the option trading world. I'm not sure if that's the best analogy that I've done, but that's the clearest way I can see it in my mind. The Greeks are basically Greek letters that we use in the option trading world so as to, for example, talk about the time that is passing, which we usually refer as theta, which is the Greek letter for the time decay. Or for example, we use also delta, which is the value that an option is losing or gaining depending on how the stock moves. Or for example, like vega, which is the amount of value that an option price is gaining or losing depending on how the implied volatility is moving. So just to tell you that basically, if you want to know where an option is at in terms of its value and everything, if you look at the Greeks, it will basically help you know what is going to impact the most the option prices. And to be clear, this is nothing really like super complicated when we talk about the Greeks. You just have to imagine that this is like, a dashboard panel, like as I said, with the fuel indicator, like the speed indicator, like, this is just like numbers to help you understand how is an option being influenced in terms of option price by all those different factors that we talked about before, like the time, the implied volatility, the stock moving. You can basically put this under numbers that can help you quickly know how is an option behaving based on what and what. So the first Greek that we can cover, which is probably the most famous, is what we call delta, and that's usually referred by this triangle. Delta is how much value an option is going to gain or lose for every dollar change of the stock. For example, if you see that an option has a delta, I don't know, of let's say 50 cents, then you can know that for every dollar change in the stock price, so if the stock is currently at $100 and it go to $100.01, then the option will have taken 50 cents more, for example. But if the option is going, for example, to $101 to $100, then the option is going to lose 50 cents. So that's how delta works. Then another one that we call theta, which usually is being referred to as this sign. Theta refers to the time decay. So the time decay is, as it says, the decay of time, like how much value an option is losing on a daily basis. Because remember that I told you that every day that passes, basically options, insurances in general, are losing value. Well, with theta, you can actually know what is the amount that an option is losing exactly on a daily basis. And another example, if you know that theta is, for example, I don't know, let's say 2 cents, and 1 day passes, then you know that the option is actually losing 2 cents. Pretty straightforward, right? So another Greek that we often refer to is vega. So vega is often referred to as a V. That's the Greek letter for vega. Vega is how much value an option is gaining or losing based on every percent change for the implied volatility. So let me give you an example so it's clear, because I know it might be a bit complicated. We talk about the implied volatility in percentage. For example, if you have, let's say, a $50 stock that has an implied volatility of, for example, 100%, then we expect a movement of $50 because 100% of 50 is 50. We expect a movement of $50 up, either down or up. That's what the implied volatility is. It's expressed in percentage, and that's basically that percentage, you basically multiply it by the current stock price, and that's the movement that we expect, either up or down, because of course a stock could either go up or down. So as we said, if you have a stock of $50 and you expect an implied volatility of 100%, then that's a movement of $50 either up or down. So the stock could either go, for example, to $100 or basically $0. So that's what the implied volatility is. And vega is basically, you can measure for every percent change, how much value is the option going to gain or lose. So if you, for example, have, I don't know, a vega that is, I don't know, let's say of 30 cents, then if the implied volatility goes from 100% to, I don't know, 100% to 101%, sorry, then the option is going to gain 30 cents. And vice versa. If it goes to 99%, then the option is going to also lose 30 cents. So those are basically the three main Greeks that we talk about. And there are other ones that we call second order Greeks. So the ones that I just talked about right now are called first order Greeks. And then there are other ones called second order Greeks. But I won't go into that because for the moment it's not really necessary. If you already know this, like, you know, that's already enough and you will just learn more with time, but for the moment it's just good enough. So now that you know all of this, you know, for example, how an option works, what is a call option, what is a put option, what does it mean being in the money, out the money, what is intrinsic value, extrinsic value, the Greeks, blah blah blah, all of this. What should you do with it? Well, now that you know all of this, it basically sets up the ground for what you can do with it, for strategies. When you know all of this, you know how the Greeks works, when you know how to sell options, you can now start assembling all of this and start, for example, using strategies. For example, one strategy that I very much like is selling a put on a stock that I'd like to own. And the reason for that is that as I'm selling a put, I'm going to collect credit on a stock that I wouldn't mind owning, and so I'm going to make a profit that way. And if the stock actually drops and then my put falls in the money and then I get a sign because the option buyer decides to exercise the option, then in that case I'm going to have to buy 100 shares of a stock that I didn't mind owning anyway, and I just made money by selling an option on it. So you can see that now it's actually much better to sell an option, for example, selling a put option on a stock you wouldn't mind owning compared to buying the stock directly, because now you can actually start using all of this knowledge to basically create strategies that are going to make you benefit from either movements of the stock. And that is basically the beginning of the real rabbit hole. Once you go in there, like, there is no going back. Like, once you know all of this, once you know about options and you know how to use them, it's really where the fun starts. And I've made plenty of videos about strategies, how to use them. For example, I really invite you to watch my video on how to use the wheel strategy, on the poor man covered call, or any other strategies. You'll also see plenty of other strategies online, and that's really where you can combine the usage of the Greeks, for example, so as to help you create all the strategies. I really recommend you though to check out, for example, the Tasty Trade YouTube channel. They have a great library of content, and you'll see that what you learn right now is really going to help you understand what they're talking about. So I really advise you to go check their channel, go check their website, and learn as much as you can. I try to give you like a guide where it was a bit more practical, and I try to take a different approach compared to what you see usually on YouTube. Like, there's no gimmicks, there is nothing. It's really just me trying to make the message come across in the best way as I can, and I hope that I managed to do this. If you enjoyed this video, I really appreciate, you know, just leaving a comment, telling me what you thought about this video, and maybe dropping a like and subscribing. That would really mean the world to me. Please always make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.